All right, let's go ahead and get started. Welcome to the BullHouse podcast. Today, we are very excited to have Dave Lauer on our show today. I'm joined with Kenna from the BullHouse, another staff member.
Hey, guys.
Hey. Dave, thank you so much for joining us today.
Sure, thanks for having me on.
Okay, so I think we'll just jump right back into this conversation that kind of took off yesterday. Let's talk about that big green candle we saw in the after hours on GME. I think a lot of our listeners are very curious as to why that happened. Do you have your thoughts and opinions on that?
Yeah, sure. So I should say that when I initially saw it, it looked strange to me. But what I did, so just to kind of walk you through the way I look at these things, is the first thing I did was I just pulled up a time and sales report, and I looked through it, and I found the closing print. So GME trades on the New York Stock Exchange, and it's important to understand that though there are so many different stock exchanges out there, there is a listing venue, the place that the stock is listed on, and that venue, generally the New York Stock Exchange or the NASDAQ, or it's kind of a duopoly in the US where you can list, or where firms choose to list, I should say, has some primacy in some very small places. But the main thing is the auctions. So, everyone is, I think, used to the idea that there is, for the day, an opening and a closing price. But maybe you haven't really thought about how those prices are established. And this is something that I've spent a lot of time on and used to run trading strategies around these prints, and they're established through auctions. So there's an opening auction for every stock in the stock market. There's a closing auction for every stock in the market, and a huge amount of volume tends to be done in these auctions. So what happens around these auctions is that sometimes there are funds that need to hit the opening or closing price. And an example, which we saw yesterday, is when a stock is added to an index on a it's anytime a stock is added to an index or an index is rebalancing, that happens as of a date. And what you need to think about is the index is maintained, let's say in this situation by S&P Standard & Poor's. They're the ones who decide which stocks go in which indices that they publish, and they make a lot of money publishing these indices, as well as how the constituents should be weighted within the index. And there are different ways to do that. Market cap is one of them. Sort of just a uniform weighting is another. There are all sorts of different ways, and not terribly important here. But what S&P said was that as of yesterday, the closing price is the price at which we are going to start to track GME's performance in the S&P 400. Now, there are all sorts of ETFs and mutual funds that attempt to replicate the performance of that index and other indexes. And they are judged by something called tracking error, which is the difference between the performance of the theoretical index and the performance of their actual fund. And there are multiple sources of potential tracking error, including execution costs, but one of them would be not getting that closing price on the day that the stock is added to the index. And so all of these funds have to come into the market and they have to participate in that auction, because if you participate in the auction, you are guaranteed to get that closing price using a certain order type and other factors that are probably too detailed to get into here. But you have a way as a fund, as an ETF or mutual fund, to say to the NYSE, okay, I need to buy, I don't know, 100,000, 500,000 shares of GameStop in order to make sure that the performance of my ETF or mutual fund mirrors the performance of the S&P 400. And so that's what happened yesterday, was that these funds came in and they said, this is what we have to do. We have to hit the closing print. And so you saw a very large amount of volume transacted because most likely you probably had a very large buying imbalance. And I'm just sort of speculating. I haven't looked at the imbalance information, but basically the way the auction works is 15 minutes before the close, the auction book gets locked, I think, on the NYSE. It works differently on NASDAQ, where it's 10 minutes before the close. So once the auction book is locked, then the exchange determines if there's an imbalance. Are there more buyers than sellers? If there are, which is probably what happened here, then the exchange will start publishing imbalance information, and it will say, hey, we've got a lot of buyers here. Do we have any sellers out there? Anyone want to sell? And so you'll have other funds come in, usually short-term traders, potentially high-speed traders, and they will buy that stock in the open market, and they will put an order into the auction to sell it. And so they'll try and capture that 15 minutes of alpha that they forecast based on the imbalance information. And so that's how you would have, an equal number of shares come into the auction to be sold versus, matching up against that buying interest. Was that all clear?
I thought it made perfect sense. So that's an excellent way of viewing that, because we saw the same thing happen when GameStop went into the Russell 1000, correct? Like we kind of saw those same green candles because it had
Right.
to reallocate and everything, correct?
Yeah, that's right. That's right.
Yes.
And that's usually what you'll see. And let me actually um, pull up something here. Let me look at yesterday's action. Okay, so what's interesting here is that um, what you started to see is that right around 340, it started to move up really hard. Now, there are other kinds of imbalance messages that get released at different times. I know in the NYSE, actually, they release them at much, I think there are ones that are released throughout the day. There are some weird NYSE floor messages that get out there, but then you can really see, looks like right at 345, the big run started, which was probably the ARCA messages that got released. So, what you saw was suddenly a ton of buying ahead of the auction, and then it dropped really significantly right before the like in the minute or two before the auction, and then the auction kind of just cleared at a price somewhere in the middle. So it does look like there were a bunch of people trying to position themselves ahead of the auction. It probably ran so hard that it went past what they forecast the impact of the auction to be. So then they all tried to rush out of it, which is why it dropped. It's funny, but I've seen this pattern enough times and sort of been part of the pattern enough times that this is just kind of the story around imbalances in an auction, and it's like a weird thing to see if you haven't looked at it before, but it's not an uncommon pattern. And this is an example of sometimes like these things can flip, right? So if the price moves up too high, you won't have enough buying interest up there. And actually, even though there's a buy imbalance that's been broadcast, the auction itself might actually drop the price because it went up too high. So it's complicated, but yeah, I do think that's what happened looking at the chart.
Well, thank you for that explanation. I think that I think a lot of us were curious to see what was happening, especially for the new retail investors that are not used to seeing that kind of action. It was questionable at best, and then now we have a little bit more information. So we appreciate you answering and responding to that.
Sure.
Okay, so we'll dive into a couple of the questions that we created a while ago. So how about this? Which do you think affects the stocks most negatively? So is it high frequency trading, dark pools, or payment for order flow? And then which, if any, do you think should have more regulation and follow through on that regulation?
So I think the one of the biggest problems in markets, I think there are two. Well, there are a couple of big problems, and one I would say is just the simple complexity of markets. It seems like things are just too complex and unnecessarily so. HFT thrives in a complex environment because that's what they do. They master the complexity. They just study it and they engineer it, and that's what makes to a certain extent HFT successful, is mastering complexity. Dark pools, I think. And I think by dark pools, you probably mean just broadly off-exchange trading. Because for AMC and GameStop and other retail-heavy names, most of the trading takes place over the counter, not in dark pools, which are two types of off-exchange trading. I don't believe that dark pools are a huge problem. I think there are problems with conflicts of interest on the institutional side with dark pools, but I think the level of OTC trading and off-exchange trading is a huge problem, and that is facilitated by payment for order flow, but not dependent on payment for order flow. To me, payment for order flow is a conflict of interest, but it's somewhat of a it's not really what to focus on. It's really that level of off-exchange trading, which is the most important to focus on. And so I think if you addressed that, you would make markets more efficient. You would make them simpler. you would bring down execution costs for everybody. And so if I had a wand and could wave it, I would change the rules to focus on I would change the rules around off-exchange trading to make them more similar to the Canadian rules, which I think do a better job of balancing on-exchange versus off-exchange trading.
Dave, for the newer people that are just getting into investing, because what I'm seeing is astonishing that people are actually saying that over the counter is the same as dark pools. Can you clarify the major difference? I mean, there's a big difference between the two, but just kind of in layman's terms, the difference between over the counter versus dark pools, since it is kind of being put together, which they shouldn't be.
Yeah, and it's I don't blame people because this is super complicated stuff and it's nuanced and if you haven't spent time studying it, you might not know that AMC and GameStop hardly trade in dark pools at all. And you might see things in the data that you have access to because you're using your broker's, data or charting platform or time and sales, and you're seeing things that make it seem like all of these trades are taking place in dark pools when they're not. So a trade, when a buyer and seller meet, it can, broadly speaking, happen in one of two places: on exchange or off exchange. So it can happen on a stock exchange, which is a licensed venue that the SEC regulates, and those stock exchanges are household names like the New York Stock Exchange, the Nasdaq, and some names that aren't as commonly known like IEX or BATS. Or it can happen off exchange. Now, if it happens off exchange, generally speaking, it happens in one of two places: a dark pool or over the counter. So a dark pool is more lightly regulated than a stock exchange, primarily run by large institutional brokers, although not exclusively. So to give you an example of some dark pools, let me just pull up some info. So you have the five biggest dark pools are run by UBS, Goldman Sachs, Credit Suisse, JP Morgan, and Morgan Stanley. Those are the five biggest. They're all run by large institutional brokers. Those dark pools are accessed by institutional asset managers and high frequency traders, broadly speaking. So if I'm an institute, like I'm a mutual fund company or I'm a pension plan, I need to go buy 1,000,000 shares of Microsoft. I go to UBS, who's my broker, and I say, buy me 1,000,000 shares of Microsoft. UBS will take that 1,000,000 share order and they'll put, let's say, half of it in their dark pool, and the other half they'll split up and route all over the place. They'll send it to other dark pools, they'll send it to exchanges, and they'll try and find counterparties for that trade while trying to mask that trade so that it doesn't impact the market. If the market finds out that I'm buying 1,000,000 shares of Microsoft, the price of Microsoft is going to move really significantly, and my broker is going to try and help me avoid that. So that's what happens in dark pools. Now, OTC facilities are run by firms like Citadel and Virtu, right? So Citadel, for example, does not have a dark pool. There is no Citadel dark pool. There was at one point many years ago. There's not anymore. Virtu itself, they do have dark pools, but those dark pools are the results of acquisitions, not things that they've built themselves. And generally speaking, Virtu also does institutional order execution. So again, like the Virtu dark pools, which are small, I don't even think they make the top 10 dark pools. Those are for their institutional side of their business. When a retail order goes to a retail broker, that order is sent generally 80% of the time to Citadel or Virtu. And that order is executed in what's called OTC, over the counter. So Citadel and Virtu will pay the retail broker most of the time for that order flow. That's payment for order flow. And they will, as soon as they receive that order, fill it either themselves or they'll find a way to fill it, and they'll send that fill back to the retail broker, and that trade will go to that retail investor or trader, and that trade will have happened off exchange, but not in a dark pool. It would have happened OTC or over the counter.
Thank you. Yeah, I couldn't have said better myself.
Well, thank you.
No, I think it's really vital that we start kind of clarifying up some of these different terms and how they work, because it's, goodness. I mean, what are we doing? Like 6 million new investors, I think I saw this year, or something crazy.
Yeah.
It's astonishing. And so that's kind of the main goal of what we're doing at BullHouse, is just the education, and it's, whether it's what's a stock to what's the difference between OTC and dark
Right.
pools.
Right. And it's complicated, and like I have this a mental picture that I've developed over a long time of doing this kind of thing, that I can kind of draw on. And if you don't have that picture in your head, this gets very quickly, you can kind of get drowned in the jargon. You can get overwhelmed by people who, talk very earnestly about things, but, haven't actually experienced it or built it. And so, it's hard. It's hard to like really master and understand this stuff, and that's part of why it's a problem. Like this level of complexity is problematic. And other countries, for example, are not as complex or fragmented, and very few developed nations actually allow payment for order flow and off-exchange trading of retail orders. And for good reason, because they've made the determination. They understand that when an order gets executed off exchange, you are penalizing somebody on exchange, right? If I am a market maker and I'm posting the best bid in the market, and a trade happens off exchange at the price that I just posted at, that is somebody queue jumping. That is someone jumping in front of me to a price level I created. I took the risk to post that price on a market, and someone else jumped in front of me because they had a backroom deal with a retail broker. And that's not okay. And so when that happens repeatedly, it acts as a disincentive to market making. So that market maker won't keep making those aggressive price levels because they just get stepped in front of. And so when they quit making those aggressive price levels, spreads widen and costs across the market increase for everyone, retail investors and institutional investors. And that's why I've been against this practice for 10 years now, and pushing the SEC and Congress to change it and do something about it, because other countries have recognized this problem. So in Canada, for example, you only have 8% or so off exchange trading, versus the US, where I think in July it was something like where was it 44%. I mean, that's crazy, and it's unsustainable, and I think it's a big problem for markets.
So you kind of answered our question too in this whole thing. So I'm gonna kind of just skip ahead, and Kenna, why don't you jump to question 3 if you don't mind?
Yeah, so this one actually came from Twitter, which I thought was fun. That we kind of gathered some questions for everyone in the YouTube that doesn't know. We gathered some questions from everyone in our community. So the question is possibility of a reverse split for AMC. Like, do you see AMC reverse splitting their stock to limit cost of covering? Like, could that help? The hedge funds have to cover their short positions and everything. And I think they gave it, for instance, if there's 5+ billion shares, now what is the cost to cover? Answer any part of that question that you can if you want to. Lots of speculation.
Yeah. Okay, so in theory, it sounds possible, in that most of the time when you are paying fees in the market, you're paying per share. And that's on, when you're trading on exchanges, you're paying access fees, which are per share. But if you're trading off exchange, you can have different models of fee structures, but generally they're still per share. So if there were fewer shares, there might be some way to save on the per share fees, but I don't think the fees are a terribly material side to this. And for example, if there were 5 billion shares, which I'm not saying there are, but if there were, and that amount of buying had to take place, the market impact of that would be far orders of magnitude higher than any fee savings that might come about from fewer shares to have to buy. It would still be the same amount of notional value that would have to be bought. So, usually professionals don't see splits as a material event in any way, reverse or otherwise. Reverse split might be material in that maybe you as a company are close to running afoul of listing requirements, and so if you drop below a certain price, the stock exchange might delist you. So maybe you reverse split to stay above there. But from a practical trading perspective, a split doesn't really affect anything because the notional value that you're trading would stay the same.
I think the best one, so our community has been following the Torchlight metamaterial fiasco that's going on. Um, I guess that would be something that we could all kind of use in that instance, is because they did a reverse split, which killed, I'm sorry, but it killed my cost point on Meta when they finally merged. I don't want to talk about it, but oh man, it was brutal.
You are not alone.
Like,
So you mean like your broker didn't know how to handle the split, and so it showed your cost as something it wasn't?
no, so
No,
they did a 2-to-1 reverse. So our shares halved and our price point doubled, and then they I don't know if you've been following Meta, but it's now sitting at
no.
$3 and some odd, and when they merged, it was at 21. They did so Meta Materials is Canadian. They got listed onto the Nasdaq. They're the first one of their type on the Nasdaq for metamaterial company, which they merged. They took over with Torchlight, and they created an entirely new IPO.
Was it a SPAC?
Yes, I believe it was a spec. Our main person for this was is Tyson, so he would be the. I wish he was on here today. But yes, I believe they. No, hold on. I'm thinking.
Meta Growth Corp?
Meta Materials is the. It's MMAT is the ticker.
Oh, okay.
So yeah, if you want to look at that. But
Sure.
yeah, it's had like big shorts. They have all these like awesome partners that they're with, and I mean it was just an insane thing to see. They're using graphene material in a lot of
Mhm.
their products, and it's a revolutionary company, granted, and they have like different patents and whatnot. So I'm not gonna plug them much more, but anyway, it's the same instance with the reverse splits and things like that. Like I personally reverse split would not be the greatest for a lot of people because it would not a spec. Thank you, Aaron. Thank you, Aaron. But yeah, they
Okay, I see here it's split 1 for 2 on around June,
yeah.
the end of June. Okay. And
Yeah.
then it just kept dropping, and so that's
Yeah.
yeah. I mean, I don't. It doesn't looking at the chart. It doesn't look like the split had anything to do with it had run up to 22 and then now was dropping.
But it
Like,
hit 22 when they merged. When they reverse split, that same happened, right? Like Torchlight and Meta merged together about like the same
mhm.
2 days, like at that same reverse split. So like you had all of the MMATF shares, the original metamaterials from Canada, they were getting merged in with Torchlight shares. Torchlight's the one that actually did the reverse split.
Okay.
Yeah,
Yeah,
it was a
I'd have
mess.
to look into it. Yeah. But it does seem like that's, like your broker should be able to handle the cost basis on a split.
Oh, they can. They can. I'm just saying our price points are now double. Like they're because it was a 2-to-1. We halved our shares and doubled our price. Is how
Right.
they did it, right?
Right.
Um,
Yeah.
so yeah,
Didn't also issue us like special shares that haven't yet
yes,
shown
yes, they
in the
did.
broker as well.
Yeah, they did a preferred share dividend
Hmm.
for Torchlight if you held it through a certain date or whatever. So yeah, look into it. I would love to pick your brain on this one because I'm
Okay.
officially stumped on it.
Do you know? And it's listed in Canada on.
Mm.
Is it a venture or
It's
a
um it's ac-
TSX?
it's actually on Nasdaq. It's just recently listed on Nasdaq since June. Um, it was Yeah, MMAT was the brand new IPO. It was MMATF in Canada on the Canadian exchange. I think it's MMATX now on the Canadian exchange, and Torchlight is gone. TRCH is gone.
Okay.
See, we do broad market. We look at everything. I mean, it's a interesting, definitely something to look into.
All right. Yeah. Sure. I'll take a look.
So yeah. Okay, so I guess we can go on to 4. Sorry. Um, on ETFs, could he please explain if and which, if any, there are fail-safes to ensure underlying assets of shorted ETFs are accounted for a reporting standpoint? And what are the obligations of the ETF creator to locate the underlying asset?
Um, so the way a creation works is you have another firm, an authorized participant, of which Citadel is one, and there are many others. And basically, what will happen? If I'm an ETF market maker, I'm I'm trading the ETF, and in the simplest situation, I'm trading the ETF against the underlying, the constituents of the ETF. And what I will do is I will measure whether the ETF is trading at a premium to the underlying or at a discount to the underlying, to the basket of name, the basket that would result in a share of the ETF. Now, my experience, and this is a bit dated, but in my experience, what we would see is that premium or discount would persist throughout the day. And so the whole day, for example, we would be selling shares of the ETF and buying shares of the constituents. Then you would get to the end of the day and you would be short a bunch of the ETF and you would be long a bunch of the constituents. You would go to the ETF provider and you would say, okay, here is a basket of underlying shares. And this is, let's say I'm short 100,000 shares of the ETF and I'm long a bunch of these different, 500 companies. I would say, here's the basket of these companies. And the ETF provider would say, thank you for giving me those shares. Here are your 100,000 shares of the ETF. This is a creation operation. And so, because what was happening all day is I was selling shares of the ETF to people, right? And so, as the market maker, and so they give me the 100,000 shares of the ETF that I was short, and that brings me back to net flat, right? I have given them all of the stock that I bought, and they gave me the shares to offset my short position, and now I'm flat. And that's the goal of generally of a market maker, is you don't want to have a directional exposure to something. You want to be flat and you want to make premia wherever your models model it out. So in terms of that process, there is no more, I would say, fail safes, for example, in that process than there is in any kind of trading in the market, right? I'm sitting here as a market maker buying shares of these underlying names, and then I deliver those shares to the ETF provider, and that all sort of reconciles in the back office, just like every other trade in the market. Does that answer the question? It's a process that I spent a lot of time on when I was in ETF market making. But I I'm not sure. I've seen sort of some theories out there in terms of like shorting things using ETFs that I haven't really looked at it much or paid much attention to because I guess my experience is more plain vanilla on the ETF market making side.
I did follow the ETFs. I found the thing I'm most known for around the GME AMC community. I'd created this huge mind map web, right? And it had all
Hmm.
of the ETFs that AMC and GME shared, which
Hmm.
was about 21 before the changes with GameStop. This was a few months ago.
Hmm.
And I actually found that the IWM, IWN, VB, VBRs, and I want to say IWO. Those were the main. Oh, and SoFi. Those were the main ones that were shorted. I mean, they were talking 100% utilization on most of them. And, and obviously, like, there's more than one company in these ETFs. Like, for those that don't know on YouTube, like, you can have 10 companies, you could have 500 companies. You just have to look into them. But, um, yeah, there
Oh,
was. Oh, there it is.
here's her. Dave, I don't know if you can see this.
Yeah, yeah, yeah.
Yeah, so
Great.
this is I'm working on updating it. I'm leaving this one as it is because this is the original. So over here on the right, the GameStop ETFs, this is all the GameStop ETFs that it was in. The bottom one has AMC's ETFs, and then together I found the ones that they shared, if all the way to the right. Yeah, the little black
Hmm. Hmm.
firework. And I think total out of those, about 10 of them, they had actually been shorted through, looking through Fintel and Ortex. So, the common things that, us regular retail people can look at. But I was finding a lot of them were at 100% utilization. So I thought that was interesting.
So, okay, right, and so it doesn't shock me that they would be highly shorted.
Mm-mm.
It's in sort of in context of, markets at all-time highs. And if you're out there looking to short the market, shorting an ETF is a good sort of low cost way to do that. Especially because you don't run into, like if I'm shorting in the futures market, for example, I have to short a contract at, on a certain date. And if I'm wrong, I have to roll that into the next month and the next month. And so there's a cost to that roll that doesn't necessarily exist if I'm going to short ETFs. I don't, I given that like GameStop and AMC are pretty small constituents of these,
Yeah.
it would surprise me that like that would be a part of some strategy that involves those two names. I'm not saying it's not possible. I feel like I say this a lot. It's just not, it's not something that I can kind of piece together myself.
Right. No, and that's it's something that the big reason I did that whole thing on that section is because of the continuation at that point. GME and AMC they kept following each other. They kept having the same chart
Hmm.
movements. And I had to
Right.
figure out why. What is the why to this whole craziness? Because everyone kept screaming, "Oh, it's manipulation, it's manipulation. They're doing this, blah blah blah." And I'm like, "No, let's think logically. There's a reason for this." And so that's when I started tracking all the ETFs and whatnot. And come to find out, I actually started being able to pinpoint which one was actually being, I don't want to say manipulated, but messed with. I'll say that, whether people were buying or selling or whatever in these ETFs, because I would look at Apple and Tesla because I figured out which companies were in each ETF, and you
Hmm.
see the same chart movement in all of them. I'm like, oh, they're messing with IWM today. Oh, they're doing something in SoFi today. Okay, well, Amazon and Apple are up with GameStop. Well, AMC is not in that one, so it must be this one. So it was kind of a fun little experiment, and I think I wasted way too much time following it, but so yeah.
Yeah, again, some of these things don't surprise me. For example, seeing correlations in AMC or GameStop or seeing correlations like that. It's just these are going to be correlated names. They're sort of like high beta, high retail interest names, even though you sort of wouldn't think it at first blush that a video game company and a movie chain theater would be correlated. When you have the the kind of retail dynamics that we're seeing, um, and consistent, retail buying pressure, for example, potentially, then it's not terribly shocking to me that there are pretty significant correlations there.
Yeah. It's just it's a fun little experiment. Marissa, I think we have a couple more questions, general questions, and YouTube is popping off with 1,000 questions. So we
Course they
might have to ask you back for a part two, if
Sure,
that's possible.
sure. Yeah, sure.
Okay, so here's another one from Twitter, our Twitter followers. It says, with regards to total return swaps, do you feel that they may have a significant role to play in shorting scenarios such as GME? And if so, how?
Um, so I was kind of as surprised as I think a lot of people in the industry, when Archegos fell apart
Mm,
and the techniques that they had been using came to light. Uh, it's that's not obviously, like, people were helping them to structure those swaps, and so it's not like this was some sort of backroom secret. But I don't think any of us had realized how per pervasive it is, and the incredibly high level of exposure you could get to a stock without having to register, a 13F for it. So I'm glad that I think the SEC is going to make some big changes around disclosure requirements, and I think FINRA's already asked questions about that too, in terms of better shortening disclosures. The chair of the SEC has talked about better disclosures, or just having any disclosures, for short positions, same as longs. So I think we're going to see a lot of movement here. Could they have a significant role to play? Yeah, I mean, sure. That's what Archegos showed us, is that there are really potentially, that they weren't quite systemic in that, the damage was isolated to a couple brokers, but that could have been a systemic situation, and it's fortunate that it ended up not being one. I don't know how much, like, Dodd-Frank has, in terms of the impact that it had in muting the systemic nature of that blow up, but I think that it made it clear that people can get significant exposure, long or short, to a single name, with a swap that doesn't have to be disclosed. So, could it have a significant role? Absolutely. Is there any way to say one way or the other, given the level of disclosures that we have in the market today? No. I mean, there's just no way to know, because it's not something that there's any transparency on at all.
okay.
I think you literally just like blew apart my mind.
Yeah.
I'm gonna have to go back and re-listen to that, because it's like there's some things that just got totally lost when you were explaining it. Like, oh boy, Dave, good
Yeah,
job.
I mean, like, we like to think of the market as sort of this simple place of buying and selling shares, and then,
Oh,
the financialization of every security, and the derivatives and leverage, and the people have figured out how to structure and turn into, massive leveraged positions, is crazy. And it's part of what was the cause of the great financial crisis. And we're starting to see these kinds of things seep back into markets.
oh yeah.
And so, yeah, I think a lot of people are really concerned about this kind of derivative, and thankfully, because I think that means something will actually get done, and it's rare that anything actually changes in markets. But I think this is one area where we're going to start to see a lot of disclosure real soon.
Yeah, it's something that we like, since we do follow a broad market, like, we're following the real estate, crypto, commodities, you name it, we're watching it.
Hmm.
Man, I wrote an entire piece about like the history repeating itself. My husband actually brought forward the fourth turn. Right, I had never even heard of this thing about people act the 80-year cyclical event or whatever. Mine was based on
Hmm.
100 years, because I was like, well, 1929 to the 30s. Okay, well, we're in 2020. So I started looking back, and most of my team laughed at me, because I was like, guys, Like this is every 100 years or something, some kind of financial crisis. And they laughed at me for about 3 weeks, and then I had to finally like just put it to paper. Like, no, look, there is something here. And so yeah, it's something to definitely look at because we are in that cycle right now, the 10 to 12 year cycle, that the stock market does, the 18-year cycle the real estate does, and the 80 to 100-year cyclical event of the just all overall economy. And yeah, it's I'm curious to see what happens, definitely, and I'm happy that people are willing to actually listen and take note of what's going on. Um, I think we have.
So do you want to do one more, Kenna, from Twitter?
Yeah, we can, and then we have some special questions.
Okay. So now that GME is on the Russell 1000 ETF, how is the price being affected by short hedge funds? What about the S&P 400, and how are the ETFs rebalancing affecting GameStop and AMC?
I don't know that being part of an index or an ETF necessarily changes the dynamics all that much. I think that when these indices rebalance, it is an opportunity for potentially on either side. It also, being part of an index tends to give you a broader ownership base because all these ETFs and mutual funds have to include your shares, so you start to get more institutional ownership, which is good. But then again, a lot of these companies lend out their shares because they're looking for other sources of income. So I think I don't have a good answer for this, unfortunately. I don't know of a particular impact being part of these ETFs would, what a particular impact would be. So I'm not sure, I guess, is all I can say.
Well, that's okay. That's what I admire, that. Like, no, I don't know. I'm just not gonna do it.
Yeah, I try hard not to speculate if it's something I'm not sure about.
100%. I believe
Right.
that. So I have a question. I heard a rumor that you have a special project in the midst.
Yeah, yeah. So we're, what I've seen in the couple of months now that I've sort of been engaged with this community is I've seen the level of data that people have access to, and it's bad. It's
I agree.
Quite frankly, it's shockingly bad. And I think for someone who's used to professional data and tools and the quality that comes along with that, and having operated at sort of the highest level of data in the industry, it's been a surprise to me. I guess I've never really paid attention to it. I've had retail brokerage accounts, but I don't really trade much through them. It might be surprising, but I'm just not that active of a trader because it takes a lot of time, and I find that if I'm not putting a lot of time into it, I'm not getting much out of it. So I haven't really paid attention to the kind of data that retail has access to. And I think the same is true with a lot of the people that I've spoken with in the industry. Nobody that I've spoken with had realized, for example, if you get time and sales from most brokers, it's just bad data. You're seeing things in there that you shouldn't have in there. Either they're not filtering out trades that should be filtered out, or they're misaligned in terms of timestamps with like the lit data versus the off exchange data, and it's like simple stuff like that any professional would know how to deal with. You don't see that in these data sets. So that was really where I started talking to some of the guys that I work with, because we work with this kind of data on a regular basis, and we said, maybe there's something we can do here that we can help solve a problem. And that we know where the best data is. We know the best data vendors. We know all sorts of different kinds of data vendors who have really interesting data sets. And so we started talking to them and saying, hey, is there a way to provide this professional level of data that they only sell to institutions? Can we provide that at a retail price point? And we started to figure out that, yeah, there is a way to do that. And so, that's what we want to do, is we want to provide that professional level of data and tools, and then we want to help facilitate better DD, like where instead of using sort of a generic platform to just do this on your own, we could help communities come together and either collaborate on DD with this high quality data and tools, or come up with their own kinds of signals or proprietary data or research techniques, and sort of create like this creator economy around that, where people can get compensated for high quality information or research. And I don't know, it's an exciting idea to me, because it kind of brings together my professional life for the last 15 years, and sort of this new phenomenon that I've just started to get exposed to, which is the ascendancy of the retail trader and investor. And so
you can say the apes. It's okay.
The apes. I want to help the apes, and I
Yes.
want to be a silverback. And I mean, I do. I love, like, the community has been fascinating. Sometimes really negative and harsh, but other times like super positive and fun to deal with. And what excites me is that I can see clearly that a lot of people want to learn about market structure. And I've said this many times now, but like that's never been the case. I've been talking about market structure for a long time now, and it's never been something that's kind of captured popular attention. It sort of briefly did when IEX and Flash Boys came out, and they were on 60 Minutes and such, but it that kind of just dissipated pretty quickly. And now I think this actually has some staying power, and I think it should. Like, people should be in markets, and they should understand how markets work, and they should be invested. And I think that's an exciting thing to be a part of.
I absolutely
So,
love it. I abs-
so I just saw on a message on YouTube from, I hope you don't mind, Chris Taylor, I'm totally calling you out, but he was wondering if there was going to be any kind of education folded into your component, your
Oh
terminal.
yeah, yeah, absolutely. So the way we describe it is it's like a three-legged stool. One is better data and tools. Another is this idea of community and collaboration. And then the third is education and advocacy. And that's the kind of thing that we're super excited about. And I'm talking to people. I've over my career, I've met a ton of people, and a lot of really good people, and a lot of them are so. I mean, they're just laughing as they watch all of this unfold and see me as involved, and it's such a like a kind of crazy trip, but they love it, and they love the idea that retail is getting empowered and involved in this area, because for a long time, like I said, that hasn't been the case, and it's hard to make change happen, especially if you need sort of like Congress to care about something. They don't care about something that people don't care about. And so uh, what I've done is I've talked to them and I've said, hey, if we launch this platform and we want to provide free educational resources, and all sorts of ideas around that, like webinars and articles and maybe eventually MOOCs and stuff like that. I've been asking them, is that something you want to help with? And almost across the board, people have said yes. And I know people that know like the craziest thing about like a very small part of the market, or people that know stuff about fundamental investing, or how AI can be used for retail investors, or how like one part of this the DTCC might work, and they all are like, yeah, we'll come on and talk about it. So yeah, I think education is going to be a cornerstone of it. And it's, even though for the way we're structuring this is, we'll provide as much as we can for free, but high quality data does cost money, and there are simple licensing requirements around a lot of this, where people just have to pay. And that's why they don't have access to good data right now. Is there's a lot of people want it for free, but you pretty much you get what you pay for. And And so, what we're trying to figure out is what's the most we can do for free from a data perspective, but from an education perspective, that will always be free, and that will always be something that we just will invest in, and we will love that to be part of this platform.
I love it, Dave.
Awesome.
That's exactly. I mean, whatever you need from at least me and probably Lady, like that's exactly what we need to do. Because like everything a BullHouse does is free. Like we will never pay, like whatever we find, we're learning it ourselves or we're finding it ourselves. Like why not spread that knowledge? Like
Yeah, yeah.
I absolutely love it. You're taking the best things that the apes, the retail investors have, developed. We use the tools, we share our tools with one another. We post our DD on Reddit or Twitter or wherever everyone's posting their
Hmm.
DD at this point, and we're educating each other. So you've really taken the best aspects of all of it, and man, I'm excited for it. Like,
Thanks.
so and when are you guys starting your crowdfunding? Like, how are you gonna try to get this up and running? Do you have a set date maybe that you're gonna start trying to?
Yeah, actually, so we actually launched it um, to a to our email lists, I guess 2 weeks ago, and then we launched it publicly last week.
Last week?
And so that's the other side of this is I want the community to own it, not just you know be the pay the subscription revenue, for example. I think that's a great model. Um, and it's one that like this is the ape model, right? The model is you love a company, you buy its shares to support it, and then you become its best customer and you help it get better. And I just think that's the best model, and I just want to replicate that and make sure that our incentives are always perfectly aligned with our customers and our shareholders. And that's to me just a great way to do it.
That's absolutely phenomenal. Marissa, do you have a question?
No, I'm just very excited about the idea of identifying a problem and offering a solution. I mean, that's amazing.
It is.
Um, so I guess we'll finish with this question, Dave, and of course this is a very important question. Do you like the stocks?
um, yeah, I mean, I posted it on Super Stonk when I bought GameStop, and I have not sold that position. And I posted my price that I got in, and it's still in the money, although it's come down, but I think I'm at a pretty good level of support, so I'm not terribly concerned. Um, and AMC was one that I hadn't really looked at much. I did put a trade on at one point, but I think that I think AMC is an interesting potential play, but I just haven't done the research, and GameStop. I was more immersed in the community at the time, and so it was sort of just an easier decision for me. But yeah, I mean, I think that when you have a base of investors that are holding this with diamond hands, that's a really unique situation in markets, and there's no reason not to want to try and be a part of that.
I agree.
With the caveat, and I think it's very important, only with money that people can stand to lose. If this doesn't work, which is always a possibility, not one you can just simply dismiss. In the worst case, these stocks drop a lot. I wouldn't want to see people get hurt or have real problems in that situation. You should always plan for the worst, hope for the best, right?
Thank you for saying that. It's something we iterate all the time because I don't know if you've been seeing the stories or the posts that people, take out a second mortgage or I don't know, there's been some,
Sold their car or something.
yeah,
Yeah, that kind of stuff scares me, and I don't want to have contributed, to someone making a decision like that because of something I said, and then getting hurt down the road. I think that's too much risk, and I hope people aren't doing that.
So, and I do want to, I'm seeing a comment in our YouTube, and guys, just because Dave, he hasn't done the research on AMC, and that's fair. That's 100% fair. If he he's a trader. He's been in the market for a long time. So, I don't want you guys to say that he's saying FUD about AMC.
Well,
You know,
yeah, I
a,
know that's the problem.
no, it's
And
it
anytime
is.
I say something that doesn't hit, confirmation bias, it's FUD, and I'm not I'm not trying to do that. I'm just being honest with
No,
how I look at things.
and that is perfectly fine, guys. AMC is a very unique play. It came in after GameStop. GameStop had a wealth of information. People, Roaring Kitty, whatever you want to call him, Keith did a great job, bringing to light the interesting play with GameStop. He brought it to light. AMC came afterwards. He really did. So, it's fair. It is fair to say, to look at GameStop and say it's the OG. AMC is the kid brother. Came afterwards. Yes, there's a bunch of people holding it, but you can't dispute it, right?
Yeah, yeah, again, like that, and that's I usually just hesitate to comment at all on when I get that question because if I say, oh, I'm heavy into these things, people might go overextend themselves, and I don't want to be responsible for that. And if I say no, I'm not, then I'm spreading FUD, and I'm not trying to tell people how to invest or trade in any way. My expertise is on plumbing and market structure. I'm not a financial advisor. I'm not like my quantitative experience was in trying to forecast price movements over a couple of seconds or even like 20 milliseconds. I have no experience or expertise in forecasting like 6 month or 1 year price movements. That's just not anything that I should comment on or something that you should take from me. You do your research and you've got your conviction and more power to you.
If people can predict a price point 6 months out of any stock, please give me your crystal ball. If there's anybody out there.
Yes, that sounds good.
Yeah, I agree. Yeah.
Thank you so much for joining us, Dave. We really appreciate it.
Yeah, sure thing. This was fun.
I hope you can come back. Maybe we can set up a part two. I'm going to gather up all the questions off of YouTube and we'll try to do this again if you don't
Sure.
mind.
No, that sounds great.
All right, everyone on YouTube, we will see you again and
Thanks
probably
again.
Friday.